very happy morning, happy afternoon, happy evening based on what time you're watching this lecture. So now let us move on to a very important topic, small but important topic, mainly when you're talking about your interest element, payment chapter. So when you talk about your payment chapter, the provision for payment chapter starts at basically it is section 49. Now it has been extended to section 49A and 49B. Basically it talks about payment by way of your electronic credit ledger. So when you talk about payment, please understand that whenever you talk about payment, supposing you're having a gross output tax liability. So there's a gross output tax liability which you have to pay, and assume that that gross output tax liability happens to be your 10 lakhs. Right now, when you pay that gross output tax liability, the first thing that you will do is paid by your credit. Whatever credit balance input tax credit you have, that is ITC, you will pay that. Let us assume that you have ITC of about 3 lakhs. Now only the balance portion you are going to pay it by way of cash. So that would amount here to your 7 lakhs. Now that exactly is discussed in your section 49, section 49A, 49B. Now when you see the rules, first it talks about your electronic liability ledger. So basically you're talking about your gross output tax, electronic liability ledger, creation of liability. That liability basically is paid by your, first you will try using your credit. So you're talking about your electronic credit ledger. Whenever you have some your gross output tax liability, you will make sure that first you're discharging your liability with the available input tax credit or your credit balance, and your input tax credit will go and hit your electronic credit ledger. And if there is a balance that you have to pay, even after setting off your input tax credit, if you have some balance, that you will pay it by your cash, that is you will be using your electronic cash ledger. Electronic cash ledger. Now coming back here, as discussed, the provision that basically discusses about this particular payment is your section 49, 49A, 49B. Read along with, when you see your rules, you will find your rule 85 electronic liability ledger, 86, 86A, 86B basically talks about your electronic credit ledger. Read along with your 88A, that also discusses about your electronic credit ledger. So you are talking about your credit ledger being discussed in multiple places, not only 86, 86A, 86B, also 88A, 88A. Then you have something called as cash ledger 87. You have something called as your cash ledger 87, and you finally have your unique ID for each transaction. Whatever transaction is hitting your liability ledger or credit ledger or cash ledger, that will generate a unique identity number for that transaction, so that in the back end you can have a reference of that. So basically, if I want to simplify, it is section 49, 49A, 49B for payment. What payment? Payment of tax, interest, or any other amount. It is not only talking about your tax, interest, it is talking about payment of any amount, payment of tax, interest, any amount. And as discussed, whenever you have a liability that will hit electronic liability ledger, rule 85, first you will try to close it off by your credit ledger. So electronic credit ledger is basically there in a rule 86. 86A, 86B talks about restriction on utilization of input tax credit. But basically this 86A and 86B, that portion we have covered in your input tax credit chapter. 88A also deals about the order of utilization of input tax credit. Then you have something called as final payment that you will be having, you will be paying with the help of your electronic cash ledger. And when you talk about every transaction hitting these three ledgers will go and set in the portal, which are going and sitting in the portal, will have a unique identification number for that particular transaction, that is rule 88. Now talking about something called as the another important provision called as your interest. Interest in this chapter is discussed in section 50. Now interest is also having a rule called as rule 88B as to how to calculate the interest or compute the interest in case where you had some credit balance and then your credit balance came down. So there is some special calculation for interest when you talk about wrong availment and utilization of ITC. Wrong availment and utilization of your ITC. So we'll be discussing that. So interest on delayed payment is discussed in your section 50. Initially it was covered only in section 50. Now you have a rule for it, rule 88B. 53A section, there's another section which we'll be discussing indirectly in this particular chapter. Section 53A talks about transfer of certain amounts. So you'll understand that in the back end from one cash ledger you can transfer the amount to another cash ledger. So when you are transferring the amount from one cash ledger of say SGST state government to another cash ledger of central government CGST, then in the back end there will be certain transfer of amounts that is discussed in your section 53. So that is indirectly related to your payment chapter. Basically the provisions are 49, 49A, 49B and 50. 53A is a kind of related provision when there is a transaction or transfer between two cash ledgers, one belonging to central government, one belonging to state government. So that will be discussing when we are talking about your cash ledger. Now, as we have understood now, there are basically three ledgers which you have. One is your electronic liability ledger, another is your electronic credit ledger, another is your electronic cash ledger. So whenever you are talking about your payments, you have to think about all these three ledgers. Please understand that as far as GST is concerned, we have to do maximum work on the portal. So that being the case, you are focusing on all these three ledgers on the portal, GST portal. Now, as already discussed, when you talk about payment, what are the basic kind of tax? If at all it is an intra-state supply, it will be CGST, SGST or CGST, UTGST as the case may be. If it is an interstate supply, it will be IGST. So these are liabilities. Plus additional liabilities can be if you are paying late, you may have to pay with interest. If you are filing your return late, you may have to pay late fees, or for appeals you may have to pay fees. If there is any penal proceedings, there will be penalty or any other amount. So basically when you are talking about your payments, what are your payments? Tax, interest, penalty, fees and any other amount. Tax, interest, penalty, fees and any other amount. So that you need to understand. Now we have certain definitions that we need to understand before we go to the next part. Now what do you mean by output tax in terms of section 2 clause 822 of CGST Act and valid return in terms of section 2 clause 117 of your CGST Act? So they have defined your output tax, and you will understand the significance of output tax when we are discussing these ledgers. They have defined output tax to tell that tax chargeable under this act on taxable supply of goods or services or both, but it will not include RCM. So your output tax will not include RCM. We'll understand the significance of your output tax when we are seeing the ledgers. Basically when we are seeing your credit ledger being used, right? So what is your output tax? Output tax means tax chargeable on your outward taxable supply. So basically your tax chargeable on your outward taxable supply, but it will not include tax that you are paying on your inward supply, because when you are paying on your reverse charge mechanism, you are paying on inward supply. So you can understand in this part, whatever tax you are paying on your outward supply, basically in layman's language, sales or your output service, so that is included in output tax, but it will not include RCM that you are paying on. It will not include RCM that you are paying on your inward supply. So that you need to understand. Now what is a valid return? So when you are going to file your return, and the next chapter that we are going to see, maybe more clearly you understand, valid return in terms of section 2 clause 117 means a return which is furnished under section 39 subsection 1, that is the first criteria. You have filed your return under section 39 subsection 1, plus another important criteria, whatever is your self-assessed taxed, whether correct or incorrect, you have self-assessed it. It may be right, it may be wrong, that has been paid in full. So there are two criteria. One here is you are filing your return under section 39 subsection 1. Second, whatever is the self-assessed tax, I repeat, your self-assessed tax may be right or may be wrong. It may be calculated correctly or it may be calculated wrongly. Your actual tax liability is 10 lakhs. You may have put self-assessed taxes only 1 lakh or only 10,000. Let it be. But whatever your self-assessed, that should be paid in full. And basically understand that today in the GST world, your portal will not allow you to file the return without paying this tax in full. So basically, you can understand in this way. The way GST portal has been designed, www.gst.gov.in, you cannot file your return under section 39 subsection 1 without paying the self-assessed tax in full. Indirectly, it means that all the returns that you have on your GST portal are only valid return. Understand that all the returns on GST portal have to be filed electronically. There is no such provision called as manual return. You don't have any exception whatsoever. And understand another point that without paying your self-assessed tax in full, portal will not accept your return. It will not allow you to file the return. So if I could tell that in today's scenario, whatever return you are filing on GST portal are valid return, this statement is fairly true for a very simple reason that if your self-assessed tax are not paid in full, portal will not allow you to file the return. Without payment, portal will not accept your filing of return. So that you need to understand. Now, let us start with something called as your electronic liability ledger. So now we have a fair understanding of what are the provisions that we are going to discuss in this chapter. We have fair understanding of the introduction and the definitions that were essential for understanding this chapter. We'll now move to your electronic liability ledger. What we have done is to make this chapter pretty simple. We have given all these three ledgers. Basically, this chapter initially revolves around your three ledgers: your electronic liability ledger, your electronic credit ledger, and your electronic cash ledger. So what we have done here is, first we have given all these three ledgers in kind of your accounting debits and credits. First, let us understand that how your liability will be created. How basically your liability is created. What is the basis of creating your liability? Either liability is created by assessee himself, self-assessed output tax liability by assessee himself, or liability is created by officer, output tax assessed by the proper officer. Either assessee himself creates liability or liability is created by the officer. So self-assessed liability by the assessee, tax liability, and officer creating the liability. Now let us understand that what can be the other liabilities. What can be the other liabilities? If you see the first 2 points again, you will find the same set of points. Now you may wonder why these points are given again. So again you will find that self-assessed liability by the assessee, and you are talking about liability created by the proper officer. You might find that again the same thing is repeated, but you will understand what is the reason in few minutes. Now understand that whenever a liability is created, you need to close that liability by paying it. Now payment can happen in two modes. I have a liability, either I paid by my credit ledger using my input tax credit which is there in my credit ledger, or I paid by my cash ledger by depositing the amount by way of NEFT, RTGS, online payment, cash, check, etc, etc. So I have to first deposit the amount in my electronic cash ledger. Right, now understand that my credit ledger, the credit ledger that I have, can be used only for payment of output tax. Credit ledger can be used only and only for payment of output tax. It cannot be used for payment of interest. It cannot be used for payment of penalty. It cannot be used for payment of fees. It cannot be used for payment of any other amount. Your credit ledger can be used only for payment of output tax. Whether assessee himself has created the liability or officer has created the liability, you can use your credit ledger, but only for paying your output tax. So as far as your credit ledger is concerned, credit ledger can be used only and only for paying your output tax. Cash ledger can be used for anything. So cash ledger can be used for paying self-assessed output tax or interest or late fees or any other amount. It can by which is self-assessed by the assessee, or it can be used for payment of output tax or interest or penalty or fees or any other amount which is assessed by proper officer. It can be also used for payment of your TDS, GST TDS, that is section 51, GST TCS, that is section 52. For a reverse charge mechanism, as I said, output tax will not include tax which is paid under reverse charge mechanism. Just a few moments back we have discussed about your definition of output tax. Output tax means tax which is chargeable on the taxable supply, which means you are focusing on outward supply, but it will not include or it excludes tax payable under RCM, because when you are paying RCM, it is your inward supply. RCM always understand that you have to pay it by cash ledger one hand, immediately you will get the amount in credit ledger other hand. So first you have to pay it by your cash ledger. So RCM cannot be paid by credit ledger, you have to pay it by cash ledger. Section 10, composition tax, because composition scheme dealer cannot take credit, he will not have any credit per se, it has to be paid only by way of cash, any other dues. So there are few specific payments, very specific payments that can be paid only by way of your cash ledger. They are your TDS, TCS, your RCM, composition tax, interest, penalty, late fees, any other amount. Let me put it this way. If you are categorizing your various payments, if you are categorizing your various payments, so it can be tax, it can be your interest, it can be your penalty, it can be fees including late fees, it can be any other amount. It can be any other amount which is due. I'll further categorize tax as my regular tax. I'll categorize my tax as TDS or TCS, or I'll categorize my tax as RCM tax or composition tax. So tax further bifurcation can be your normal output tax, or your TDS, TCS tax, or RCM or composition tax. Right, now if you look at the answers, only this first part, which is a tax, which is a regular tax, not being TDS, TCS, not being your RCM, not being your composition tax, only that portion can be paid either by using your credit ledger or your cash ledger. Rest all of them, it can be paid only and only by your cash ledger. Only a very limited portion, it should be tax, and that too it should be a regular tax, not being TDS, TCS, not being RCM, not being composition tax. Only that can be paid by first credit ledger, or if you want you can always, cash ledger can be used for anything and everything. Cash ledger you can use it for left, right, center. Government will be very happy the moment you're using cash ledger. It can be used for anything and everything. Rest everything else, the moment I tell everything else, right, starting from TDS, TCS, RCM, composition tax, interest, penalty, fees, any other amount, only thing is you can pay it by your cash ledger. You cannot touch your credit ledger. You may have crores of rupees in your credit ledger, but you have to pay all these amounts only and only by way of your cash ledger. You cannot touch your credit ledger for that purposes. So that, friends, you need to understand. So that is being clearly given here. And when I am talking about your tax, that output tax can be ascertained by the assessee or by the officer. So that is in difference point. Now what is the order of discharge of liability? In which order you are going to discharge your liability? Supposing, let us see this order of discharge of liability by way of an example, because this can be directly explained by the way of in a very simple example which is given for both example 2, which will be covering it. Again, let us touch example 1 first and then let us move on to example 2. Now what is this example 1 talking about? It is talking about the same thing that we have discussed now. When you are talking about tax, whether it is assessed by yourself or by the assessee, You can use your credit ledger as well as cash ledger. When you're talking about any other type of payment, let it be interest or penalty or late fees or any other amount, you cannot use your credit ledger, only cash ledger. If at all I tell that it is a composition tax or RCM tax or TDS or TCS, again you cannot use your credit ledger. You have to pay it only by way of cash ledger. That we have understood. Now let us understand the other part. What is the order of discharge of your liability? Supposing you have multiple liabilities of different months, in which order you have to close the first liability? Right now, this situation will arise only when you have liabilities of various months. There is a liability which is pending of say Jan 2019. There is another liability which is pending of say your April 2019, then May 2019 and June 2019. The difference is the first liability which is pending is officer assessed liability, and the other liabilities are self-assessed liabilities. So that is one liability of Jan 19, other is of April, May, June 2019. Now first understand that your priority will be always first to close your own assessed liability, then to close your officer assessed liability. So first you are going to close your own assessed liability. So preference will always be to your self-assessed liability, then to your officer assessed liability. Now in self-assessed liability you have April 19, May 19, June 19. So first close the entire liability of April month, then go to the next month May, then go to the next month. When I tell entire liability, please understand that when I tell entire liability, first close the entire liability of April month's tax, interest, penalty, etc., etc. Then close the entire liability of May month, tax, interest, penalty, etc., etc. Then close the entire liability of June month, tax, interest, penalty, etc., etc. That is the sequence that you have to move at. And finally you have to close your officer assessed liability. So the last would be, okay, once you have discharged all your self-assessed liability, close your officer discharge liability. Now one may wonder what difference it makes. It makes a difference when you are talking about calculation of interest. You would like to close officer assessed liability first because it is interest is keeping on ticking and interest will be more. But no, you cannot touch that first. You have to first pay your self-assessed liabilities. Right? Or you might think that okay, I'll pay only taxes of all these means first, then I'll pay interest and other amounts. No. So if at all you are touching first April month, the law is telling you first to close all the dues of April month, whether it is tax or interest or penalty or late fees, whatever it is. Then go on to the next month. Otherwise, what a particular assessee will do, he'll have a limited funds and in order to stop his interest calculation, he'll pay tax of all the months, but he'll not pay interest. Even now he can do, but obviously that is not in accordance with law. Law tells that if you have self-assessed liabilities and officer assessed liability, give priority to self-assessed liability, then to officer assessed liability. In self-assessed liability, first focus on the earlier months, then focus on the latest months. And when you're focusing on those months, first pay all the liabilities of that month before moving on to the next month. So that is explained by this particular example too. So that was all about your order of discharge of liability. In which sequence you have to close down your liability, in which particular sequence you are required to close down your liability. So that is given here. Now understand that the next question which will come up is, what is the due date of payment? If you look at the provision specifically, due date of payment is normally linked to the due date of return filing. So whatever is the due date of return filing, that will be the due date of that would be the due date of your payment. Please understand that whatever is the due date of your return filing. So due date of payment is given in this way. Whatever is the due date of your, whatever happens to be your due date of your return filing is the due date of payment. So whether you are talking about your regular taxable person, whether you are talking about your regular taxable person, or you're talking about your casual taxable person, or OIDRS or TDS or NRTP and etc., etc., what are they telling? It is whatever is your due date of return filing, that is your due date of payment. If I tell that I am a regular taxable person, my due date of April month return is 20th of May. So on or before 20th of May, I have to make the payment and file the return. So my due date of payment as well as due date of return filing is exactly the same, 20th of May. So that is basically the first point. But when you're talking about QRMP scheme, when you're talking about quarterly return, monthly payment, due date of payment is different from due date of return filing, because return filing you will be doing once in a quarter, that is once in 3 months, but payment will happen every month. Payment will happen every month. So when you are going to see QRMP scheme, you will find that due date of payment is separate and due date of your return filing is separate. So that will be keeping it for your return filing chapter, that will be discussing that. Even when you are talking about your composition taxable person, you are required to make the payment on quarterly basis, but file the return on yearly basis. So quarterly basis within 18 days. Quarterly basis within 18 days. To put it a very simple manner, so I can analyze or assess this in this scenario. Normal cases. That is the first scenario. Second, you are talking about QRMP scheme. This QRMP scheme is only for regular taxable person and your casual taxable person. Third case is your composition scheme. QRMP scheme, which is for regular taxable person and your casual taxable person. No one else can go for this QRMP scheme. So if I am talking about your normal case, due date of payment, your due date of payment is equal to due date of return filing. Due date of return filing. If I am talking about your QRMP scheme, we'll be discussing that in your return filing chapter. So it is to be discussed there, not to be discussed here. Better we discuss that or take it there in your return filing chapter. It will be different for the first 2 months of the quarter and it will be different for the last month of the quarter. Right. So we'll be discussing that in your return file. Rather, I'll not write return filing. We'll be discussing that in a return filing chapter. But it is not due date of return, because in QRMP scheme, the full form of which is quarterly return, monthly payment. Your payment will be on monthly basis, but return filing will be on quarterly basis. Quarterly return, monthly payment. So now your due date of payment cannot be linked to your due date of return filing, because payment is monthly, return filing is quarterly. Your composition scheme. In your composition scheme, it is 18th day after the end of quarter, which means for April to June quarter, 18th of July. That also will be discussed in basically in return filing chapter. From from July to September, it is 18th of October. From October to December, it is 18th of Jan. From Jan to March, it is 18th of April. So like that, you have to understand it is after the quarter is over, you have 18 days for making the payment. So basically, maximum cases, your due date of payment is your due date of return filing. Major cases. Obviously, there are exceptions. Composition scheme, it is 18 days after the end of the quarter. And when you are talking about your very special scheme, QRMP scheme, that will leave it for your return filing chapter, because the answer is different for first 2 months of a quarter and last month of a quarter. So that is given here. Now, this particular point, the next point which is given, we have already discussed this, that all the returns that you file on your GST portal are all valid returns, because unless the person has paid self-assessed tax in full, he is not in a position to file his valid return. Right. So unless he has paid the entire self-assessed tax, he cannot file his return. So all the returns as of now that you're seeing which are filed on the portal are valid return. And unless the supplier has paid the entire output tax and filed his return, recipient is not eligible for ITC. Now, two important things. I am your supplier, you are the recipient. Unless I pay my self-assessed tax, I cannot file my return. And if I don't pay the tax, first thing, I am under problem because I cannot file the return. Also, my recipient, my customers are under problem because they cannot take the IDC. They cannot take the input tax. We have discussed in detail about your input tax provisions There are a lot of conditions for claiming input tax credit, where one of the conditions is supplier should have paid the tax in order to ensure that recipient is enjoying ITC. So it is disturbing both. If as a supplier, if I am not making the payment of self-assessed tax, I cannot file my return. So that is my problem, because I am not paying, I am not able to file my return. Not only it is affecting me, if I am not paying the tax and I am not filing my return, my customer, my recipients are not in a position to claim the input tax credit. So that is given here.